Good day, students. So today we will be discussing chapter 12, which is all about liabilities. And here are our learning objectives. First, state the recognition criteria for liabilities. Second, state the initial and subsequent measurement of financial liabilities. And then third, state the measurement of provisions, contingent liabilities, and contingent assets. Okay, to continue, the next slide, we will be discussing the nature of liability. So liability as being defined, same as in the commercial accounting, this is a present obligation arising from past event, the settlement of which is expected to result in an outflow of resources embodying economic benefit or service potential. So again, when you say liability in general, these are obligation arising from past transactions for which the company or the entity is expected to settle this liability, which will result in an outflow of economic resources. And you do have additional explanation for liability. It means it is a present obligation. So means that as of the reporting date, an obligating event must have already occurred. So again, since this is a result from past event or transactions. And when you say an obligating event, this is an event that creates first a legal obligation. So it means an obligation coming from a contract or a particular legislation or other operation of law. The second is a constructive obligation. So this is a obligation that results from the entity's action. For example, its usual practice or its policy that create a valid expectation from other that the entity will accept and discharge certain responsibility. So when you say constructive obligation, this is a particular result from the entity's normal action or normal operation. Okay, it is not resulting from a contract, a legislation, or the operation of law. It is based on the usual practice of the entity. So that's constructive obligation. Now, as to the recognition criteria for liability, a liability or an obligation is only recorded when all of the following criteria are met. First, the item meets the definition of a liability, wherein it is a present obligation arising from a past transactions or events. Second, it should be that it is probable that outflow of resources embodying economic benefit will require to settle the obligation. So take note, it should be probable. Okay? And of course, the obligation must be, or it can be measured reliably. It means it has a cost or a value in it. So these are the recognition criteria. Again, to recognize an item as a liability, first, it should meet the definition of a liability. Second, it should be probable that outflow of economic resources will be required to settle the obligation. And of course, the last one, its cost or its value can be measured reliably. Now let's take a look at a sample of a liability. You call it as a financial liability. Okay, a financial liability is a liability that is a contractual obligation to deliver cash or another financial asset to another entity. So you call it as a financial liabilities if it is paid in cash, no? Or a contractual obligation to exchange financial instruments with another entity under conditions that are potentially unfavorable to the entity. So again, you will exchange a financial instrument with another entity under conditions that are unfavorable to the entity. So it is more or less outflow on the part of the entity. And then letter C, it is a contract that will or may be settled in the entity's own equity instruments. So you're talking about bonds here as well as equity instruments. Okay. So you have here the specific example, no, of a financial liabilities as what I've mentioned earlier. So bonds payable. I know you're quite familiar with this account title, no? So these are the usual financial liabilities of an entity. Accounts payable, notes payable, interest payable, loans payable, bonds payable, or the accrued payables. So those expenses that are incurred but not yet paid. So you call it as the accrued payables. Now let's talk about the initial recognition of the liability. Of course, it is recognized when the entity becomes a party of the contractual provisions of the instrument. So you will recognize it once the entity becomes a party of that contractual provisions. So it is based on an instrument. Initial instrument will be fair value minus transaction cost. Again, it is measured at fair value minus transaction cost, except for financial liabilities at fair value through surplus or deficit. Okay. And when you say transaction cost, these are incremental costs that are directly attributable to the acquisition, issue, or disposal of a financial instrument. Like for example, the best example for transaction cost is the cost of issuing your bonds. That's part of the transaction cost. So basically, it will be deducted to its fair value. Now, for the subsequent measurement, you will base it at amortized cost, meaning you consider interest, no? Time value of money. Okay? Again, subsequently measured at amortized cost, except for financial liabilities at fair value through surplus or deficit, which are subsequently measured at fair value. So normally, the items considered as financial liabilities at fair value through surplus or deficit, these are short term, okay, wherein it is outstanding for less than a year. But for those long-term liabilities, normally subsequent measurement is at amortized cost. Now, to derecognize a financial liability, it means how liability is extinguished or it is written off in our financial statement. So financial liability is derecognized when it is extinguished, such as when it is discharged, waived, canceled, or it expires, or when you pay for that obligation. So of course, the obligation will be extinguished, or if it is a contract, if the contract expires, or you will cancel the contract. Now, as to provisions, by nature, when you say provisions, this is a liability of uncertain timing or amount. Okay? So, in general, this is a contingent liability wherein you will provide provisions. It means you will record a particular amount assigned to that contingent liability. So again, as to timing or as to the amount, you do not know. It depends upon the condition or the contingency, if it will happen or if it will not happen. Okay? But then, prudence will dictate us that we would anticipate expense or liability rather than asset, no? So that is why we did recognize provision, or we will recognize provision, even though liability is uncertain, as well as the amount is also uncertain. Now, a provision is recognized if all the recognition criteria for a liability are met. It means it is a present obligation, there is a probable outflow of economic resources, and more or less, the value or the cost can be measured reliably. For example, mga lawsuits, no? So those are an example of a contingent liabilities. As to timing, you do not know when. As to amount, you do not know how much, but there is a certain probability that the event will happen because it is an ongoing lawsuit. So that's the best example for this one. If one or more of the criteria are not met, the item is a contingent liability, not a provision, and therefore not recognized as a liability. Now, for contingent liability, this will be recorded as part of your notes, but not as provision in your financial statement. So you have it here. If you're going to say contingent liability, it is more or less possible, not probable, that the obligation will arise from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future event. Unlike provision, it should be that the amount is probable. There is a probable outflow, no, of economic benefits. But if it is a contingent liability, it is only possible. So that is why there is just the requirement for this is just a somewhat like notes. It should be written as part of the notes to your financial statement. Okay. And this by nature is a present obligation that arises from past events, but is not recognized because it is not probable and the obligation cannot be measured with sufficient reliability. So again, what the entity will do is just disclose this one to your notes to your financial statement, not as a provision or one line item in your liability section. Now, talking about contingent asset. So the same thing as the contingent liability, a contingent asset is just a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more or uncertain future events. Again, same as the contingent liability, contingent asset will be disclosed only on the notes to your financial statement. Okay, so you have it here as a summary. You will recognize an item as liability if it is probable. And if in case possible only, it will be disclosed in the notes to your financial statement. You put that as part of the notes to your financial statement. If it is remote, there is a remote possibility, then ignore. Now, for asset or contingent asset, if it is probable, disclose only. Okay? Again, prudence will dictate you that anticipate losses rather than profit, anticipate expenses rather than income, so anticipate liability rather than a particular asset. So that is why if it is a contingent asset, disclose only, no provision. And if the contingent asset is possible, ignore, as well as if it is remote, ignore. So that's the summary. And we're going to treat a particular liability or a contingent asset. Now let's talk about measurement as to the provision. So again, when you record an item as liability, it is measured at the entity's best estimate of the amount needed to settle the liability. If the effect of time value of money is material, therefore, the provision is measured at present value. You take into consideration interest. Okay, if the interest is material. Now let's talk about reimbursement. So reimbursement. If another party is expected to reimburse the settlement amount of a provision, then a reimbursement asset is recognized and presented in the statement of financial position separately from the provision. So reimbursement, however, in the statement of financial performance, the expense related to the provision may be presented net of the reimbursement. Okay? And take note that the amount recognized for the reimbursement shall not exceed the amount of your provision. So that's the nature of a reimbursement. If the entity will reimburse another party, it should be that the amount that is provided or written as liability in your financial statement should be higher than the amount to be reimbursed. Okay? So we have it here, problem 12-3 for classroom discussion. We'll have to take this one later on.